When Warren Buffett writes his annual letter to Berkshire Hathaway shareholders, he often benchmarks his own performance against a single number. Not the Dow Jones, not the NASDAQ, the S&P 500. When central banks, sovereign wealth funds, and the largest institutional investors on Earth want to understand how American equities are performing, they look at one number, the S&P 500. When the financial news tells you the market had a good day or a bad day, the number they're quoting is almost always the S&P 500. It is the most widely tracked financial index in the world. It is the benchmark against which virtually every investment strategy, every fund manager, and every portfolio is ultimately measured. And yet, most people who invest in it, or who follow it in the news every day, don't fully understand what it actually is, how it works, how it's constructed, or why the world's most sophisticated investors consistently choose to bet on it over almost everything else. That changes today. Welcome to Global Finance Watch, where we break down the strategies, trends, and decisions that drive real financial outcomes. Subscribe if you haven't, new videos every week. Let's start with what the S&P 500 actually is. The S&P 500, formerly the Standard & Poor's 500, is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. It was introduced by Standard & Poor's in 1957, though earlier versions of the index date back to the 1920s. Today it's maintained by S&P Dow Jones Indices, a division of S&P Global. The 500 companies in the index are not simply the 500 biggest companies by any single measure. They're selected by a committee at S&P Dow Jones Indices based on a set of specific criteria. The company must be a U.S. company listed on an eligible U.S. exchange. It must have a market capitalization of at least $20.5 billion as of 2026. It must have positive as-reported earnings over the most recent quarter and over the sum of the trailing 4 quarters. At least 50% of its shares must be available to the public, what's called the float, and it must meet certain liquidity standards based on trading volume. That last point is important. The S&P 500 is not automatic. It's not purely algorithmic. A committee decides which companies qualify and when companies are added or removed. That means there's judgment involved, which is part of why the index has been so durable. It's designed to represent the investable, liquid core of the American economy, not just the biggest companies by raw size. The index is weighted by market capitalization, or more precisely, by float-adjusted market capitalization. That means the larger a company's publicly available market value, the more weight it has in the index. Apple, Microsoft, Nvidia, Amazon, and Alphabet have historically been the 5 largest components, together accounting for 20 to 25% of the entire index's weight at various points. When Apple goes up 3%, it moves the index more than when a smaller company goes up 3%. The S&P 500 is not an equal-weighted collection of 500 companies. It's a market cap-weighted portrait of American corporate power. This construction has implications worth understanding. When the largest companies in the index go through a period of exceptional growth, as happened with the mega-cap technology companies through much of the 2010s and early 2020s, the index concentrates more and more in those names. By late 2024, the top 10 companies in the S&P 500 accounted for roughly 35% of the entire index. That concentration is a feature to some investors. It means the index is always heavily weighted toward the most dominant companies of the moment, and a concern to others who worry about the lack of diversification it implies at the top. Now let's look at the history, because understanding the S&P 500's track record is really understanding the case for betting on it. Since its inception in 1957, the S&P 500 has returned approximately 10.5% annually on average, including dividends reinvested. That number includes every bear market, every recession, every geopolitical shock, every financial crisis, and every panic the American economy has experienced across nearly 7 decades. The Great Inflation of the 1970s, the Black Monday crash of 1987, when the index fell over 20% in a single day. The dot-com collapse of 2000 to 2002, when the index lost nearly half its value. The 2008 financial crisis, when it fell 57% peak to trough. The COVID crash of March 2020, when it dropped 34% in 33 days. Through all of it, the long-run average annual return has been roughly 10.5%. What that number means in practice is this. A $10,000 investment in the S&P 500 in 1957, with dividends reinvested, would be worth somewhere in the range of $50 to $60 million today. No individual stock picking required, no market timing, just owning the index and holding it. The key phrase in that last sentence is holding it. The S&P 500's long-run returns are real and documented, but they belong only to the investors who stayed invested through the drawdowns. Studies by Dalbar and others consistently show that the average investor earns significantly less than the index return because they sell during downturns and buy back in after the recovery, perfectly inverting what they should be doing. The index is not difficult to own. The behavior required to capture its returns, which is essentially just doing nothing, turns out to be harder than it looks. Let's talk about how the index gets updated, because this is one of its most underappreciated structural features. The S&P 500 is not static. The committee reviews the index on an ongoing basis and makes changes when companies no longer meet the criteria due to falling below the market cap threshold, being acquired, going private, or experiencing sustained losses. And when new companies have grown to the point where they're clear candidates for inclusion. When a company gets added to the S&P 500, it's a significant event. Thousands of index funds and ETFs that track the index are required to buy shares of the new entrant to maintain their replication of the index, which typically drives the stock price up sharply around the announcement. When a company gets removed, those same funds sell, often driving the price down. The practical effect of this process is that the S&P 500 is continuously self-updating to reflect the largest, most dominant, most liquid companies in the American economy at any given moment. Companies that decline in relevance are replaced by companies that are ascending. The index owned Standard Oil and General Motors when they dominated the economy. It owned IBM when computing emerged. It owned GE when industrial conglomerates ruled. It owned the largest banks at the height of financial services. It owns Apple, Microsoft, Nvidia, and Amazon now. It will own whatever companies dominate the economy in 2040 and 2050. You don't need to predict which companies those will be. The index finds them for you. This self-cleansing property is one of the most profound reasons the S&P 500 has worked so well over such a long period. It is structurally biased toward the winners. Now let's look at the case the world's smartest investors actually make for betting on this index. Warren Buffett's case is the most famous. In his 2013 letter to Berkshire shareholders, he revealed the instructions he had left for the trustee of his estate. Put 90% of the cash into a low-cost S&P 500 index fund and 10% into short-term government bonds. The most successful stock picker in history, managing money for the people he loves most, chose a passive S&P 500 index fund. His reasoning was blunt. Most active managers can't consistently beat the index after fees, and the long-run returns of the American economy, which the S&P 500 captures, are reliable enough to trust. The data behind that reasoning is robust. The SPIVA scorecard, the most comprehensive ongoing study of active fund performance versus benchmarks, consistently shows that the vast majority of actively managed U.S. equity funds underperform the S&P 500 over 10, 15, and 20-year periods. In 2023, 87% of U.S. large-cap active funds underperformed the S&P 500 over the prior 20 years. This isn't a temporary phenomenon. It has held across decades, through every kind of market environment, across every type of active strategy. The reasons are structural. Active funds charge higher fees, which compound against performance over time. They trade more frequently, generating transaction costs and tax drag. And the market is highly efficient, meaning the information advantage that would allow a manager to consistently beat the index simply doesn't exist in a systematic, repeatable way for most participants. John Bogle, the founder of Vanguard, who created the first index fund available to individual investors in 1976, built his entire philosophy around this insight. Bogle's argument was simple. In aggregate, investors own the market. Before costs, the average investor must earn the market return. After costs, the average investor must underperform the market return. The only way to beat the average investor's outcome is to minimize costs, which is exactly what index funds do. The S&P 500 has also proven resilient in ways that distinguish it from other global benchmarks. The U.S. economy's combination of property rights, capital markets, technological innovation, corporate governance standards, and demographic scale has produced compounding returns that other developed market indexes, Europe, Japan, have not matched over equivalent periods. International diversification has value, and many investors hold it, but the S&P 500's track record specifically reflects advantages that are real and structural, not just historical luck. There are legitimate critiques of heavy S&P 500 exposure worth understanding. Concentration in the top holdings is real. When any single index has 35% of its weight in 10 companies, it is not as diversified as it might appear. The U.S. market, while dominant historically, is one market among many, and there are periods, the 2000s, for example, when international stocks outperformed significantly. And the future will not be identical to the past, even if the structural case for American equities remains strong. These critiques are the reason many investors complement their S&P 500 exposure with a total international stock market fund, and occasionally a total U.S. market fund that includes small and mid-cap companies the S&P 500 excludes. But there are reasons to think carefully about diversification at the margins, not reasons to abandon an index that has delivered 10.5% annualized returns across nearly 7 decades. Let's bring it all together. The S&P 500 is a market cap-weighted index of 500 large, liquid, profitable U.S. companies, selected and maintained by a committee at S&P Dow Jones Indices. It has returned approximately 10.5% annually on average since 1957, through every major crash and crisis in that period. Its self-updating construction means it is always weighted toward the dominant companies of the current era, without requiring investors to predict which those will be. The evidence across decades and across every type of market environment shows that the vast majority of active fund managers fail to beat it after fees. And the world's most respected investors, from Warren Buffett to John Bogle, have made the case for it in the clearest possible terms. You don't need to be the smartest investor in the room to capture the S&P 500's returns. You need to own it, keep costs low, and hold it through the downturns. That combination has worked for nearly 70 years. The people who bet on it have, on balance, done better than the people who tried to beat it. That is the S&P 500. Subscribe if you haven't, and check out our index fund investing guide and our video on how to read financial statements, both linked below. Drop a comment telling us what you want us to cover next. We'll see you in the next one.